Hi, I'm Tom Stelzer and welcome to Livewire's Alternative Series for 2025. Today I'm joined by Andrew Lockhart from Metrics to explore the opportunities in the commercial real estate sector right now. Andrew, thanks for joining us.
Thanks, Tom.
Andrew, we're in an everything bull market at the moment. Why do you think investors should be considering commercial real estate debt?
Look, I think at the end of it, what investors are looking for is how private credit can work in a portfolio. And so there's always a role for both defensive and growth investments. So private credit, particularly private credit in real estate related investments in well-diversified portfolios, can deliver for investors as part of their defensive portfolio allocation. So I think that's one of the reasons why in an environment where markets are toppy, perhaps a lot of investors might be thinking about how do they protect to the downside, and a move into private debt or private credit is a way in which people can look to gain greater stability and protection of their capital through appropriately structured debt investments.
You touched on the defensive benefits there, but how has the sector tended to perform through economic cycles, especially compared to other asset classes?
Look, if you look at the Australian market historically, the loss rates that have been experienced in Australian direct lending has been negligible. I go back to the time of the global financial crisis and the banks reported peak net write-offs of about 0.67 of 1%. And today, you look at the low level of losses that are being sustained across the market. So one of the things that's important as a lender is understanding the capital structure and where you're exposed to risk. And so as a lender, equity is obviously the higher risk part of the capital structure. So people are generally investing in equity to gain the benefit of growth in earnings and value. You're investing in debt to gain the protection of the capital structure and where you sit. So first position in terms of the defensive nature of the asset class is the risk to equity or the asset owner. And then as a lender, you then also want to protect your position through appropriate terms, conditions, covenants and security. And so one of the benefits of private debt in real estate is the fact that you're lending against an asset-based exposure. So you've got security over the property that you might be lending against. And so unless you have a substantial decline in the value of that property, equity would obviously lose its first, its capital first before a lender's position would be at risk of loss. And so obviously you have to monitor the cash flows that are being generated by those property investments because you can't have interest or holding costs eating into the equity buffer. And so a whole range of things need to be done to protect your position as a lender. But lending for real estate has the benefit of the asset backing of the property. The terms and conditions and covenants are there designed to protect the position of a lender. And then of course you can gain greater protection for investors' capital by having appropriately diversified portfolios. So you don't want to have exposure to any one individual borrower or counterparty to an extent that if you were to have a situation where the borrower underperformed, you're not necessarily putting your capital at risk or a significant portion of your capital at risk.
And have you seen attitudes towards real estate debt change amongst retail investors recently?
I think at the end of it, people in Australia have always been familiar with real estate, and I think we have an affinity with real estate. There's a lot of different views in the market. Some people think that real estate related lending can be high risk, and certainly there are differences between lenders and the risk and return that can be generated. I think because it's not a one size fits all market, it's very hard to generalize and say real estate is a good or a bad investment. You think about it, commercial office might be an asset class, or it might be residential, it could be industrial, it could be specialised securities like in the context of, say, medical centres or hospitals, or it could be in a student accommodation component. So there's a lot of subsectors. And then what I would also say is that borrowers are not necessarily correlated either. So a borrower that might be based in Brisbane that owns an industrial building might be completely different in terms of the risk and return profile compared to, say, an industrial development in Sydney. And so our role as a lender is to really understand what it is that's occurring based on each individual company or project that we're financing, understand what drives the cash flows associated with that borrower's exposure, and then make sure you're mitigating risk through appropriate terms and conditions and the security, and monitor the risk. And so I think the general perception of investors is that they like the attractive features of, the stability of capital, the attractive income that can be generated from private credit in real estate related investments. But I think there's also this element of nervousness around what they don't necessarily know or understand. So you get these comments that are often made by people about construction lending is high risk, without understanding the way in which a lender can take action to mitigate that risk through appropriate controls.
And your fund is 100% ANZ, but where are you seeing the opportunities in those markets?
Look, it's all Australian real estate related debt. The two areas where we're most focused has been in residential markets and in industrial markets. And that's largely to do with the significant growth and demand for residential property. We're very active in terms of residential high density apartments and also large scale land subdivisions. And if you look at what's driving that, a lot of that is about population growth. And you only need to look at the forecasts out to 2050, and forecasts in terms of population growth in Australia and the growth of our economy will drive increased demand for residential property. Particularly also you've seen changes in terms of the way in which our cities are formed, with higher density around transport zones and public infrastructure like the metro in Sydney. And so those sorts of things are driving demand for different types of accommodation. And so that's a real role for us to play in terms of providing financing. And so for us, what we think is a very attractive part of the market is to lend for projects where you've got your source of repayment is coming from the eventual sale of the asset. So we're less active in providing financing, say, for a commercial office or a retail shopping centre, where it might be the source of repayment and servicing of the loan is from the rental income that's generated from that asset. We're often more involved in development project financing, where on completion of the apartment building, the apartments are sold, and that provides a source of repayment for our investors.
You've covered off the opportunities there, but in terms of the headwinds, what are you seeing at the moment for CRE?
Look, I think in terms of the market conditions, for us, we've been very active in New South Wales. And so, the market again is very different around the country. In Western Australia, for instance, you see low vacancy rates, strong demand for residential accommodation, and an increasing demand for high density residential accommodation. So that's an attractive market. When I look at each state around the country, they are slightly different. Like, for instance, market conditions are tight in Queensland and in Brisbane and on the Gold Coast. New South Wales, you've got a lot of activity around transport zones and increasing infrastructure. Victoria is lagging. Like we do see a continued slower economy in Victoria than we have in other parts of the country, but we've equally had lower levels of exposure to that market for some time. But that general theme of delivering residential property in a growing population where you've got low levels of unemployment and pent-up demand for housing, together with lower potential interest rates, that's maintaining demand for the product. And then also other areas of activity and interest for us have been in the industrial part of the market. And so those two areas are areas where we're primarily focused. We've tended to stay away from areas where you've got more specialised risk. So when you think about the headwinds, for instance, we came into the pandemic period with no exposure to commercial office at all. We've had very limited exposure to retail. And so from our perspective as a lender, what we prefer is short-dated exposures where on completion of the project, the property is sold and that provides for repayment. And having shorter-dated exposures, in our view, lowers risk for investors. So it lowers your credit risk. You're involved in lending money for shorter periods of time. It reduces the market risk. So if credit spreads and market conditions change, you've got less exposure to that. But it also drives that opportunity to recycle your capital, and that can increase the liquidity available for investors in our funds.
And how important would you say diversification is in real estate debt, especially in terms of the two sectors you are focusing on, and how do you go about finding that diversification?
Diversification is critical, but not for the sake of just diversifying a portfolio. When I think about project financing in, say, in a residential development, you're looking at what is the market risk. So you've got a whole range of different things that you need to consider. Might be planning risk. Has the site got the right zoning, the development approval? Is it ready to be, constructed? Does it provide for a sufficient yield to be able to make it a viable and profitable project? And then you've got the option there to see what the market risk is. So, can they evidence that the property is going to be saleable on completion by evidencing pre-sales? So you want to see that the consumers that are potentially going to buy apartments in this building have entered into pre-sale agreements, and that they've got a diversified number of potential purchasers. And then obviously a big component is the delivery risk. And so, who are the subcontractors that are doing the work? Who's your head contractor? What are the ways in which you as the lender can control that risk? So, receipt of independent valuations, receipt of independent quantity surveyors reports, and progressively releasing those funds as and when the construction activity is being completed are key ways in which we monitor that risk.
And finally, what edge are you bringing to the real estate income strategy at the moment?
So for us, I think it's about direct exposure to a very well-diversified pool of borrowers. And that diversification, coming back to your earlier question, is critical in terms of lowering risk. Because if you're going to have a problem in a portfolio, if say one borrower was to default and we as the lender weren't able to recover the full amount, then that would be an impact to our investors' capital. And so you want to have well-diversified portfolios with good quality counterparties. And so our experience and edge that I think we bring is years of experience in terms of that market, deep networks, relationships with good quality counterparties that we do business with, where we have consistently demonstrated high levels of service to those borrowers where they want to do repeat business with our firm. And then having the resources and the capability and the depth of team that we have within Metrics to be able to monitor the risk associated with each of those individual borrowers on a regular basis. So for instance, the ability to do appropriate due diligence, have networks and contacts in the market, so you understand clearly what is the market risk for sales in a particular area, what's the construction costs and construction risk associated with a particular area, and then having a team that can be able to go out on site on a regular basis and monitor the progressive delivery of that project is all very important parts of what we do.
Andrew, thanks for joining us.
Thanks very much, Tom. Appreciate it.
Thanks for tuning in. For more from our alternative series, make sure to check out the Livewire website and YouTube channel.